What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, our focus is honestly a little bit more of a getting started approach into the investment world. We're going to talk about, if you were to start investing today or tomorrow or next week, what could you start off with doing in order to get yourself into the market? So if you are excited for today's video, make sure you like the video, subscribe to the channel, and as always, turn on bell notifications for all future uploads. So let's say that you are somebody who's been watching Fridge Financials for some time. You're thinking, Fridge, how do I get my money in the game? Well, what you'd want to do first is you want to go into a brokerage account like Robinhood, for example, as you'll see right here. You can go into Webull, you could do Fidelity, you could do Schwab. You could do a bunch of different platforms that allows you to buy stocks, ETFs, funds, whatever it is you want to, crypto even, to get started with it. Now, what you would do is this is what you would be looking at here, and you're going to create your login information. I'm not going to create one because I already have one here, but you put in all of your information. It's going to ask you, about how much money you make and your risk tolerance on Robinhood, and I think Webull does it, and so does Fidelity. You're going to answer some questions about yourself, how much money you make, what your goals are in finances, all those kind of things there, and you're going to set up your account to get started. Now, once you get started and you open up your brokerage account through Robinhood, through Webull, through whatever the case may be, your next thing would be to start funding your money and to fund your account here, okay? So what you would be doing is taking your bank account and then you're going to link it up. I'm not going to show that on my screen because you'll see my bank account information, obviously, but it's really easy to do, honestly. You'll go right in. You can be able to link your bank account into it, whether it's a checking account, savings account, whatever it is you want to link to it, to then move money over whenever you want to invest. But the major focus is not just logging into this account and getting started here. It's about, Fridge, what do I do? What would you recommend I buy? And how could I get into the market? Now, full disclosure, I am not a financial advisor. I know it's hard to believe, but I am not. And none of this is financial advice. But if you were to get started today, tomorrow, whenever you have the funds to do so, I'm going to give you guys some ideas as to where you can put your money into, and also some things as to probably where you shouldn't put your money in with where we're at in this current moment in time. So you got your account set up, you got your bank account locked in, you're ready to start sending money over. What you could do, which is really cool, is you can set up an automated deposit where you can deposit, $100 a week or $50 a week or even $10 a week, whatever the case may be. So that way it auto invests for you. So you literally do not have to log in, which I think is pretty cool. The first thing that I would say, if you were looking at getting into the market tomorrow, one of the first things I would suggest that you get into would be an ETF with like SPY. Now, an ETF stands for an exchange traded fund, and essentially the idea behind it is that it is a fund that is made up of a bunch of stocks that is managed by, whether it's SPY or it could be, you might have seen VOO, or which would be Vanguard. It's managed by a, company, a financial institution, those kind of things. And all you basically do is you put money into it, and they're going to manage this portfolio on behalf of you, basically. So if you want to get into SPY tracks the top 500 companies like the S&P 500 does, which is very nice. You get a little bit of exposure to a little bit of everything. If you take a look at the holdings here, and these are just your top 10 holdings here, you get exposure to 7.96% of NVIDIA, 6.73% of Microsoft, 6.61% of Apple, so on and so forth. These are all major companies that we all know and love and use every single day. Now, again, if you were to put in, say, $100, $7.96 would go to NVIDIA, $6.73 to Microsoft, so on and so forth. And there's a bunch of other holdings as well that goes into it. And you take a look at it, that it's basically almost all stocks, okay? And you get that diversification where you have technology, finances, consumer cyclical, communications, healthcare, industrials, a little bit of exposure to a little bit of everything. Basically, this is your stock market. This is your investment into the S&P 500, the top 504 companies. I believe it's 504, believe it or not. I don't know why it's called 500, but you get exposure to all these companies here. And the good thing is, if a company gets kicked out, they put another one right back in place. You don't have to do a thing. For example, Robinhood was put into the S&P 500, so you don't have to do anything with it. They automatically allocated some money and some percentage towards Robinhood, okay? So it's very, very nice. It's very, very simple, and it's very, very easy to work with. Now, if you take a look at the S&P 500, if you were to invest money into it, year to date, we are looking at up 14.65%. It was a little bit higher up here. We had a little bit of a pullback recently, as you will see here, because of the uncertainty in the market. And that kind of will lead me up into some ideas a little bit later on in this video about what I would suggest versus I would not suggest. You'll see the beta here is 1, which basically means it moves 1-to-1 with the stock market. And what's really important also to look at when you're investing is an expense ratio. Your expense ratio basically just talks about how much you are basically paying for management, essentially. And so this one, it's 0.09%. Not 9%, 0.09%. So a tiny, tiny bit of money goes towards that, towards the management for in this case. But essentially, other than that, most of the money is yours that is going in, and the returns are mostly all of yours. And as we'll see, up 14.65%. In the 1 year, up 13.25%. In the 5 year, up 87.64%. And again, this is your overall market. If the overall market starts to crash, we're having a big problem here. If this starts going down quick, right? It's not individual stocks. So say, for example, Amazon goes bankrupt tomorrow. They just kick it out of the S&P 500 and they put something else in place of it. So you only have a little bit of exposure and you won't lose as much money overall. So that's kind of the idea to think about as the S&P 500 index, okay? Another one that you might see, they might be familiar with, is called QQQ. Now, this one is more of a riskier asset in this case in terms of it tracks more of the technology. It's the NASDAQ. It's got a little bit more of those high growth company potentials in here. As you will see, their year to date is 19.10%, so a little bit higher than the S&P 500. So if you wanted to put some money into this one as well, I wouldn't hate it either, because if you take a look at what their holdings are, their holdings here are basically similar holdings as S&P 500, but with a little bit more weight to them, okay? Top 10 for the S&P was like 38%. This one is about 53%. You saw NVIDIA, Microsoft, Apple, Broadcom, Amazon, Tesla, Meta, Google, so on and so on and so forth. But a little bit more exposure to these high growth companies. Now, with that comes more risk. Because if you think about it, again, these are high growth companies here. So if NVIDIA, which has earnings this week, for example, crashes down, you're going to lose some money in the NASDAQ compared to the SPY. Okay, so the weightings are a little bit different here, so there's a bit more risk to it. If you take a look at the summary chart going back to here, it has a beta of 1.10, whereas SPY had a beta of just 1, which means that this is going to move about 10% more with the market compared to SPY. So, which again, maybe it's good if we have a bull market, but if we have a bear market, that is a problem, because if stocks start crashing, this NASDAQ QQQ index ETF is going to come down a lot faster than SPY will, okay? Because again, there's more exposure to those growth plays, those riskier stocks, all those kind of momentum that you see from, Tesla, from Google, from Amazon. Again, a lot of them are top quality companies, but a lot more growth, which means there's more risk to it, as you know. Also, what you'll notice is the expense ratio is a little bit higher. It's about double of the S&P 500. So if you end up paying $100 in an expense ratio for SPY, you pay $200 for QQQ. Okay. Now, what is very, very nice about this actually, which leads me to my next point, is that if you don't want a higher expense ratio, which I don't know why anybody would be like, oh, I love having this much for ratio here, you could actually go into what's called QQQM. Because QQQM, believe it or not, is very much the same thing, but has a lower expense ratio. If you take a look at the holdings here, your holdings are basically the exact same, almost the exact same allocation here, but you get a little bit less of the expense ratio. So basically the same stocks you just saw on the previous list are all listed here, the exact same ones. Percent almost identical, maybe off by like 0.1% or 0.2% or whatever the case is. But the good thing that you see here is that your expense ratio is less at 0.15. Okay, beta is the same, but expense ratio of 0.15 is very, very nice. So if you want to save yourself 0.05% in an expense ratio and fees, QQQM, it could also do the same thing. As you will see, it has a much similar return as a result. So that is something that's very, very nice to think about as well. So those are the things to take a look at here. Another one that's really good one to get into would be something like SCHD. SCHD is more of a dividend-playing company, but an ETF, essentially. Same kind of idea, but with ETFs here. Now, as you will see, SCHD is only up 0.04% on the year. But again, you're paying more into a dividend-paying ETF, which basically means that you will get paid out a dividend every quarter from SCHD. And as you take a look at the yield here, your yield is about 4%, 3.79% here. So basically every single time you're getting paid out, every quarter, a certain percentage towards a dividend payout, which is good cash flow. Okay. What you will notice is the beta is a lot lower because you're having more of those stable companies as investments. Your Johnson & Johnson, your Procter & Gamble, all those kind of ones that you're looking at here have a lot lower movement. There's a lot more stable companies. Expense ratio is super low, which is great. And if you take a look at their top holdings here, this is where you'll see the huge difference. You don't see any of those Mag 7s into here. You don't see Tesla. You don't see Google. You don't see NVIDIA. You don't see Microsoft. You don't see Meta. You don't see Netflix. You don't see any of those companies here because these are more dividend-paying companies. They're a lot more stable, which honestly right now with where the market is heading, dividend companies might do better overall as a result. As you will see, SCHD was up 0.07%. S&P 500 was down. The Dow was down. The NASDAQ finished green, which was great. Russell was green at least. But what you'll probably notice happening a lot if we have downturns in these kind of markets here, you'll notice some money come out of these, major growth companies and go into dividend-paying companies like these. Okay, so it's very, very important to keep in mind about. Now, again, having that kind of allocation is definitely very, very important. Now, those are just a couple of the ETFs you can look for. So you have SPY, you have QQQ, you have SCHD. Now, this would be a good way to kind of diversify your portfolio. If you were to start investing tomorrow, and this is not financial advice, of course, but if you end up starting to get invested tomorrow when the market opens, honestly, I would be very careful with companies like, or ETFs like QQQ. Because right now we are pushing all-time highs, not as much as we used to, 613. We're basically getting close to those all-time highs here again. We're getting very, very close to all-time highs in a market that is super, super risky. It is a very volatile market that we are in right now, and it's not good, okay? We're pushing all-time highs. We have no labor market data coming out. We're not sure if the Fed's going to cut rates in December now because we don't have any data. We're worried about inflation. We have Trump want to talk about having a tariff dividend paycheck going out. We have all these different things. It's just not lining up for us right now. So would I want to say, hey, go gung-ho into QQQ? Probably not. If I was to start tomorrow, and then again, this is not financial advice here, I would probably have more money in SCHD right now, a little bit less in SPY, and then a little bit less in QQQ for right now. The reason why, again, is because we're at these high valuation periods of these stocks. NVIDIA, Tesla, Google, there's high valuations coming in with these companies here, and their earnings have to back it up. And if their earnings don't back it up, you're going to see a big pullback as a result of it. So right now, since we're in that kind of volatile period here, SCHD might not be a bad play, personally speaking. Now, some companies that I would avoid, or some ETFs to avoid, TQQQ is one that I would avoid for right now. Because again, it basically is the NASDAQ, but it's a ultra pro leveraged ETF. It's 3x leverage, this ETF of QQQ, which is not good. We do not like that, okay? It is a big problem. Again, the holdings are basically much the similar ideas here, but the ideas, think about, I don't know what happens equal around risks here. Let's see. What does it say for risks here? The fund invests in financial instruments, okay, 100, okay, leverage exposure, yep, which we don't want. We don't want leverage exposure here. And again, you look at the returns saying, yeah, of course, this is ridiculously high returns, right? It's like, oh my God, wow, I'm up 37% year to date here, which is great. But the beta is 3.36. Okay, if you go back to the original here, right, you can take a look at this one here. Your beta is 3.36. It's also got a very, very high expense ratio compared to QQQ, SPY, SCHD. So yes, you do get very good returns when you are in a bull market or when the markets are pushing higher. There's euphoria, there's optimism. But if this market starts to pull back and have a correction, starts to have this kind of pullback period, not only are you going to lose money in this one, but you're going to lose money 3 times as fast as just regular QQQ. That's a problem. Leveraged ETFs, when markets are at all-time high, is a very, very big risk. Okay, and there's a lot of them out there. So you see people say, oh my God, I made so much money on these companies, on these ETFs because they're leveraged. Yes, that's definitely true, but there's a lot of risk that goes behind it, which you have to be very, very careful with. If the NASDAQ drops 10% in the next, year, this leveraged ETF is down 30%. Okay? That's a big problem. Big problem. Big problem that you're looking for. Because if you go down 30%, it's going to take you more than 30% to go back up to where you started here. So it's a huge risk to play leveraged ETFs. The best time to play leveraged ETFs is after we get a big pullback. For example, if you take a look at the other day, if you got this big pullback, this is again, the high was like $90, you're down to 40. You would have lost 50% of your returns right here. 50%. You invested right here at $90 a share, you're back down at $45, around $45 or so. You would have lost 50%. And the NASDAQ didn't fall 50%, guys. But this is triple leveraged. So you would be down 50% in just a matter of a short time period, which is very, very risky. Now, yes, we did recover to all-time highs, but it does take a lot more of a return in order to get back up to where you started. You are just barely like $14 above being here. And this market has had a huge rally ever since. And you just about broke even, maybe made a little bit more money as a result. So leveraged ETFs, when we're at all-time highs, is very, very risky. Another one that you might see is SPXL. SPXL, same thing, is a 3x leveraged S&P 500 bull market ETF. High expense ratio, high beta. Very, very important to keep in mind about as you look at these returns. As you will see, this one was down 0.13, but SPY was only down 0.02. This one's down 0.13. Right? So again, knowing the difference between a leveraged ETF and not makes a huge difference. Now again, the returns are great. You're up 26% year to date, and the S&P was only up about 15% or so. So you're doing great overall, but there's a lot more risk associated with it. So as kind of a way to start to get into the markets, okay? So just to kind of recap the Fridge Financials experience here. If you were to start to get into the markets tomorrow, ETFs that you could look into getting into. SPY, S&P 500, which is a good one. This one right here. If it actually, that's the wrong one. Thank you, Yahoo Finance. It's not doing it now. Okay, can I get, nope. Okay, whatever, dude. It's fine. S&P 500, SPY ETF is a very, very good one. SCHD, very, very good for dividends. And if you wanted to get a little bit more of the growth exposure, put a little bit into QQQ, I wouldn't go too crazy right now until we have a more forward direction as to where the markets are going, because right now we are in no man's land. I wouldn't say anything against it, but SPY and SCHD are very, very much, very, very nice. If you want to also, here's a bonus one for you. You can also go into Vanguard's Total Market Index Fund here. So it's called VTI. And what you'll see here, again, a little bit less return, but the beta is a little bit higher than SPY, so you get a little bit more of that return compared to it, and a very, very, very low expense ratio here. So VTI, VOO, there's a lot of indexes to get into these ETFs. And once you start, set it onto auto invest $50, $100 every single week, and you will grow your portfolio faster than you think. So thank you guys so much for watching today's video. If you made this far in the video, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. Hopefully this gives you a head start into getting into investing and into the stock market here. Start off basic, and then when you start to get more and more exposure, more and more education, you can branch out into those individual companies, options if you want to. But for now, if you're brand new to trading or brand new to investing, start off with index funds, and your future self will thank you later. Thank you guys so much for watching, and as always, I will catch you guys in the next video.